All right. Wow. That's a different response from the automated co-host there. Okay. So one thing before we get into updated markets, et cetera, some weeks by this time I have finished the weekly roar. In this case, I haven't, but I'm going to give you some of the highlights. And as I mentioned before we turned on the recording, I was on with Rena Sherbel and the Investing Experts podcast today, and I think you get a lot out of that too. Um, and the last, I guess I'm going to say the last 5 weeks, 6 weeks, I've had like if I've had like a top five most popular articles at Seeking Alpha, I'm going to say four of them have been in the last 5 weeks. Um, and I don't know if it's the risk management subject matter, uh, my forte, or if it's including the bond stuff. I'm not sure what it is. There's plenty of haters in there too. Apparently people are riled up by some of the stuff I say, and that's fine. Yeah, it's a free world. But that it has me thinking a lot. And so this week's written report is sort of a compendium of a lot of that stuff. You might recognize some of the language, but I've kind of put it together into sort of a consolidated, what have I been saying? Because I mean, I've been on Seeking Alpha for a little over 3 years. I just hit 10,000 followers, which is actually really cool. So at least we know the stuff is hitting and helping. But there's definitely a dearth of technical commentary. We know that, but just people aren't talking about risk management. I just think a whole generation of us. I mean, and when I say us, I mean probably age 45 to 95. Male, female, U.S., non-U.S. Everybody kind of has this like fever to I want to be an investor. I'm excited. I'm like, yeah, I'm excited every day when I get up and do this too, but I'm not excited about the possibility that I'm going to get rich tomorrow. And I've been thinking about what I might call my upcoming 2026 preview. And I batted around a few ideas, but the one I may go with, because he's one of my favorite artists, Bruce Hornsby, is a song he did with Don Henley from the Eagles many years ago, "The End of the Innocence," because I feel like the last few years, even with a little hiccup we had with the tariffs in April, this has been sort of the innocent period. So many new investors, so much money going into the S&P 500. It's completely warped how the stock market works. And that's kind of what I've been writing about. Now, what does that lead to in terms of what to buy and sell right now? I think it's kind of not the most important question. The most important question is, are you going to spend all this time trying to find the next super stock only to figure out that the market, the way it behaves right now, I'll show you some charts with this, but it will give you a quick move, 5, 7, maybe 10%, really quickly, and then it's done and it recedes. I mean, I think I'll probably start with Oracle, but if I don't, somebody remind me Oracle, because it's really a classic case of what this market does when you have algorithms, when you have all this money crowded into the index, and when you have an increased passion for stock market investing, which is great, don't get me wrong, but it's a passion for investing that I think is misplaced. Because if you ask anybody probably that has never been through a bear market versus somebody who has, it's going to be two different conversations. And I kind of mentioned that in the piece this week, but it's like if you haven't been through what the stock market is capable of and will do again, I just don't know exactly when. Could be right after the Fed meeting, or it could be, right after 12 Fed meetings from now. I don't know. I don't know. All I know is that we've had this period in which everything was kind of okay. And I'm talking about, getting through the first year new administration, some different policies, not to get political about any of this, because I don't do that. But the AI trade, we're over 3 years in the AI trade, and I'll probably get this out in a Seeking Alpha article this week, next week. But 3 years into this AI trade, and everything but AI is kind of sucked. I think I actually use those words. And there's so many stocks that haven't participated. And it's like, oh, okay, they're going to come back again. Oh, and the small caps are going to rally and all that stuff. Fleetingly, yes, I'll believe it when I see it. In terms of a much longer, sustained move, because it's not about fundamentals anymore. It's about what's in the index. I wrote an article, I think, for yesterday for Bar Chart. They gave me a few, ideas. Here's a few things that are probably topical. One of them was Carvana, um, which, and I don't really follow Carvana, but boy, was this intriguing. About 4 years ago, something like that, 3 years ago, it was a $375 stock. It recently went up through 375 again, and into the 400s. But on the way, it practically went to zero. I think it was under $1. And I mean, I know what the company is, but I don't track it. And I'm sure there's plenty of really good articles on Seeking Alpha. But I looked at it and I was like, wait a minute, it made what, 7,600% in the last 3 years, but not a whole lot in the last 5 years. It's like, I mean, anyway, it just got added to the SP 500. I mean, that was kind of the timeliness of the article. But it just goes to show, I mean, what the market does with a company's stock is determined by so many things other than fundamental analysis. And again, kind of bringing it back to this really great conversation Dan and I had with the fellow who I really think was the driving force in creating the Seeking Alpha investing groups years ago. He's been in Seeking Alpha like since the beginning. And it really gave us some good insight. And it kind of helped us be sort of self-reflective on, okay, we have this privilege of running an investing group. It's something I'm doing in my semi-retirement. So for your sake and for our sake, I really want to make the most of the time and the opportunity. And not because there's going to be endless riches in it, because it's not structured that way. This is about, if you will, a bit of a legacy for me, trying to take all the stuff I have, and just as we're getting to the point in the market cycle where all this risk first stuff that's been drilled into me since my father taught me at age 16. He was a child of the Great Depression from New York. He wasn't a professional investor, but that's how I learned, and it's just not natural these days. People don't think, first, let me make sure that I'm not going to lose big. Again, on the Seeking Alpha podcast today, I talked a lot about the bond ladder, and I had to be careful to make sure that it was clear that, the bond ladder is like a side thing. It's not for everybody, but conceptually, why a bond ladder? Why a bond ladder? Why risk management? Why use inverse ETFs? Why position size? Why not just find great stocks and put a pile of freaking money in it? Well, I can't really relate to that. Never have. Probably because I was managing other people's money for so long. And I had to think about them first as a fiduciary back then. But it all goes to the same basic premise. We do not know what returns are going to be provided to us most of the time. What I love about the bond ladder is that with rates being about as high as they've been in 20 years for the most part, from maybe 7 to 10 years out on the yield curve all the way out to 30. It doesn't mean you have to hold the bonds forever. I mean, if there's inflation or rising interest rates because of inflation or for any other reason, loss of confidence in the U.S. government, et cetera. I talked about that on the podcast today. Uh, if you have that, well, you can hedge it. But maybe the best way for those who are used to saying, I want to put money in, I want to make money, okay? A bond ladder these days is going to make you about 4.5% the way I structured mine, 4.5, 4.6. But I'm not doing it because I love 4.6% over, let's say, an average of 12 to 15 years. It started at 5 years, went out to about 20 or so. It's not about the 4.6%. It's about knowing that a portion of my overall portfolio is fixed at that return if I want it to be. That's the point of the bond ladder. Okay. And obviously it gets you cash flow and all that. If rates go up, I'll hedge it. If rates go down, I'll crush it because those bonds will go up for every 1% that the 10-year yield goes down. I believe a bond portfolio such as the one I've set up is going to go up, I don't know, 12%, 15%, something like that. I think the duration, as they call it, of the 30-year bond is 17, which means if you own a 30-year treasury, even if you're owning it for capital appreciation purposes, and they start, forget about Fed lowering rates, but if the bond market brings the 30-year rate down from almost 5% to 4%, an investment in a 30-year treasury is going to make 15, 17% thereabouts. What if they lower rates to 2%? There's the opportunity. Everybody's talking about the stock market. How about you get long rates going from 5% to 2%? I believe that will be a 50% gain in bonds. I don't know. I'm going to work out the numbers and I'm going to show people using live examples because we've had this happen before. In fact, when was the last time it happened? Anybody know in the last time we had rates that had kind of gone up, stabilized, and then really came down in a hurry? Not from this level, from a little bit above 6%, maybe instead of 4.5%, 5%. Anybody know? Oh, it was around the turn of the century. Yes, sir. 2001. Yep, exactly. So, a good guess, although knowing you didn't guess, you knew. So, anyway, look, this is the nature and what's kind of going through my mind now. I wish I had a list of stock picks to spit out for you, and I certainly could. I could chart the Dow right now and tell you which ones I think look good. In fact, I'll do that before we're done. How about that? Because I know that there's some people either listening live or on the video, recording. They will want that. So, and I mean, I think it's good to stay in shape, but the idea that every day we're going to have a new thing to buy with the markets that are so in sync with each other, very, very suspicious I am that is going to be a thing. So let me do this. I am going to there. I'm going to show you some charts. I'm going to answer your questions. And I'm also going to, let me find it. I'm going to go to the short list of ETFs that we have. There we go. Okay. I think I'm going to go to that first. All right. And let's share the screen. Okay. I haven't touched this yet. It's not going to change much. I'll tell you that. And this is not a bad time, to if you have questions, help me kind of walk you through, understand this a little bit better. We'd like to try to put some sort of user guide together, but hopefully it is fairly self-explanatory. Before I get there, I'm going to talk about one other thing. And I'm just putting it out there because you're going to read about it a lot, probably starting in 2 days. So I don't know if anybody knows what copy trading is. So let me define it for you. I spent my career, managing other people's money. I was their advisor. I knew everything, I could about their personal situation, and I invested their money. Um, and I was accountable for their performance and all that stuff. And if somebody needed a little bit more of this or don't do that or whatever, it's all customizable. That's when you're a fiduciary advisor and you're trading for somebody. And back then, they had this thing called shadowing, where somebody would say, hey, I have an idea. I'm going to put $100,000 into an account with this advisor, and then I'm going to see what they do. And every time they make a trade, I'm going to take $2 million if I have that much, and I'm going to just copy what they're doing. They used to call that shadowing, and it was illegal. I'm talking like 20 years ago. Now it's all the rage. It's called copy trading. I have embraced it, if you will, in my semi-retirement. And I've had a few companies come around to me and, hey, would you run a model for us, et cetera? And there was one that really stood out, very entrepreneurial, fairly new, but really good experience. And I think either tomorrow, more likely day after tomorrow, they're going to put a post out, which we'll probably repost everywhere, LinkedIn and wherever we can. I'm sure it'll be on the Substack too, and all that, anywhere we can put it. But for the first time, I'm allowing somebody to copy trade my portfolios. Now, not all my portfolios. You can't do this with Bond Ladder, and a trading portfolio probably isn't a great fit. But I would call it the two main portfolios that we talk about in Substack and also in the Seeking Alpha Investing group. One of them is the one that you're looking at right here, where I take these 12 ETFs, half offense, half defense, and I allocate, not among all of them, but the whole structure here. But it has come to our attention, and the copy trading firms have made us aware of this, that there's some people that would love to keep up with it, and they love to know how the sausage is made and all that stuff. And there's some people are like, for a few bucks, Rob, if you made your model available to some investment advisory firm, I'm not the advisor, I don't give the personal advice, but I make the model available, and they make it so you can open an account, I think, with Interactive Brokers, and it's all pretty seamless through an app, and it can be traded for you. And I think they're not even, like, for the first 2 months, they're like, hey, open a really small account if you want to try it, and we're not going to charge you. So it really is like a free look, a free onboarding to this thing. And Dana and I met with them recently, and it just very impressive, and decided, you know what, I can't pound the table to tell anybody to do this, but I think it's intriguing. I think it's a big part of the future of investment management. I used to run these big pools of money and all that stuff. And let's face it, not everybody wants an advisor like they did 10 years ago when our advisory business was flourishing, and before we sold it. So, copy trading, definitely interesting. The other portfolio is going to be on there is my basic 2 ETF portfolio, SPY Bill, but with a twist, because I'm going to basically combine that with some of my swing trading stuff for a portion. So think of it as everything you know from the 2 ETF ROAR portfolio, maybe that's going to be 75, 80% of this other little mix. They don't disclose all the holdings, just the top 5. So I'll probably do some work underneath, and try to goose the performance beyond what's already there. So anyway, I wanted to mention that you're going to see a lot of stuff about it. And if it sounds intriguing, you'll have all the places you can click, because again, it's not our firm. It's a registered investment advisor firm that is basically like an online advisor, very fintech of them, very popular nowadays, especially with investors under age 50. And we said, you know what, this is the right time, because again, to finish where I started, it's not a stock picker's world anymore. It's about risk management, structuring, navigating through the bear profits, I should say through the bear markets, and coming out the other side with most of your capital intact. And I think the way that we do that now is just, it's not 180 degrees from what it was maybe before the pandemic, but it's like 120 degrees. And I think this is what people really need to get at. And if they like the sound of that, it's like, oh, there's finally somebody talking about that, then they should be in this investing group, or using the Substack service. If not, then it's not a fit. And I'm happy to say that because, again, we're trying to solve a very specific set of what I think are going to be the mainstream issues for a lot of investors because they've only learned how to play offense and not defense. Okay, so let's talk about this. And really what I'm going to do here before I get to some charts and then your questions is just kind of refresh your memory on what this is, okay? The Seeking Alpha podcast today, I kind of listed these. So look, we live in a world where if in the last 4 years, I had an article about this recently, in the last 4 years, if all you did was invest in SPY and Bill based on my ROAR score calculation, about to be automated and distributed, and you'll be the first ones to see it because you're the first ones to see everything if you're in the club. All I've done, 3 parts: SPY, Bill, and the ROAR mechanism to allocate between them. Well, as you'll see in a lot of stuff I'm about to put out, crushed a conservative portfolio that it would be benchmarked against, crushed a moderate risk portfolio and was neck and neck with a lot less volatility than kind of a 60-40 growth portfolio. Outperformed a lot of the JEPIs of the world, the covered call ETFs, because it doesn't fall as much because that's what ROAR's built to do. I might be a bit of a chicken shit sometimes, okay, but I don't lose big. And I'm going to start putting some charts like this out because I think people need to see it more. I've never been one to really like sit here and brag about my performance, but I do like to brag about how little risk I took to get the performance. And one of the things that you will see is simply using SPY, Bill, and the ROAR score starting like 3 years ago, not all the way back 4 years, but about 3 years ago. It's been an interesting time in the markets, generally pretty good returns. It posted an 8% return. It's not matching the S&P. It's probably half. But it had a standard deviation of less than 3. Now, if you're not familiar, a standard deviation of less than 3, I think it's probably like a 2-year treasury. So getting an 8% return with, just beyond T-bill type volatility, that's what risk management is. And it doesn't have to be in a 2 ETF portfolio, and it doesn't have to be from me, but I'm giving you the concept that you can then personalize however you wish, okay? It could be as simple as, I never want to buy an ETF, Rob, So I'm going to put 90% of my money in T-bill short-term ladder and not even go out too far. And I'm going to use the other 10% to pick my favorite stocks. I mean, that's a 10 roar score, just like 10 SPY and 90 bill is. So I'm giving you the construct here, and I'm trying to teach you where risk management starts. You can take it wherever you want it to go because you're a do-it-yourself investor. So to complete this thought, all right, I started with these, and I said, okay, I've tried this thing where I give you like hundreds of ETFs and try to analyze. And those of you who've been with us for a long time, that we've been through a lot of iterations of, okay, how do we go beyond the basics of a 2 ETF portfolio, especially when it's been so darn successful on a risk-adjusted basis. I mean, as one new subscriber to the club said, are you just telling me to just buy SPY and bill and use the roar score and call it a day? I'm not telling anybody to do anything in particular, but I'm saying if that's all you did, in addition to saving a lot of time, you historically have performed quite well. And if you want to gear it up with a little bit more equity exposure, you do that too. That's why we have the moderate one. So, but I had to thread the needle between, sort of bludgeoning and overwhelming subscribers with too much data, because we learned over and over and over again that turns people off. So it's got to be more than 2 securities we're talking about, and it's got to be less than hundreds. Okay. Even when we come out with the roar score, we'll probably automated. We'll probably do it like an app or something where you put in a ticker and it gives you one ticker at a time. We're not trying to be like that great but very complex quant system on Seeking Alpha, where there's just like data overload. If you're not a real stats person. So I added some of the others. Qs and DIA can very much go together. They offset each other, not entirely, they're correlated, but more and more now, because of the nature of markets, they're going to move this way. Well, SPY has a nice offset, which is the same 500 stocks, but equal weighted. And so that may play a role. Right now, it's not playing a role because nobody's coming up from the back to help the very biggest stocks. So the Qs keep outperforming the SPY, which keeps outperforming DIA, which keeps outperforming RSP. And it's basically like you take the top few stocks, and then as you keep adding stocks, the performance just keeps getting worse and worse and worse and worse. So, it's been happening for too long to say it's just a phase that was not created by the machines taking over a lot of what happens to our money in the stock market. It's also what makes me more interested in bonds, especially if rates plunge and there's a chance to make money there. I'm looking all over. I'm looking at commodities more than I ever have. I haven't done too much work on it yet. But, in the simplest form, you've got one commodity, oil, which is, I would say, associated with offense. And then you've got Bitcoin, which I'm not the biggest fan of, but I'm a fan of making money. And it's volatile enough so that maybe taking a small piece from time to time is going to help. I'll come back to the Bitcoin chart too, because it's kind of interesting. Then on the defense, I've got my bill. Okay, I've got this, which is a ladder. Is a Govy is a laddered portfolio, and that's 1 to 30 years. It's not zero coupon ladder, and it's not your own bonds. It's just a little bit of everything, 1 to 30 years. So it kind of acts like 7 to 10 year treasury. Okay, but I think it's a nice, efficient package, and gold is here. But and I'll skip right to this. So one way to have your cake and eat it too as a bond investor is if you own Govy, and then you say, but I want a little bit of that interest rate hedge. What if rates at the long end go way, way up and the prices go down? Well, if that happens, why not have something in the arsenal ready to use? Okay, that TBF, there's levered versions of this too, which will allow you to profit from rising rates. That's what this does. If you're familiar with TLT, which is 20 to 30-year treasury, when rates go down, bond prices go up. That does pretty well. When rates go up, it gets crushed. A lot of people piled into it when rates were going up in 2022 and 2023, and I have no idea why. I think it shows you just how much a lot of retail investors did not really even understand the basics of bonds because they were flooding into TLT. I guess thinking that, well, the more rates go up, the better it looks. But the more rates go up, the more TLT goes down. So the actual like investor return on that thing, I have to look it up. I think Morningstar tracks them. The investor return has got to be grossly negative. And all the while, I'm like, great. TLT is going down. TBF is going up. Thank you very much. I will keep tactically using TBF either to hedge other bond exposure or to try to profit from rising rates. And that's why, with the Fed meeting tomorrow, I don't know what kind of reaction it'll be, but if it's a sharp reaction and everybody says, wow, the U.S. is really losing it, we don't have trust in them anymore, we got to repatriate some of our money in treasuries. Long rates are going to go like this, straight up. Prices are going to go down, and this is going to be a nice little profit center in this portfolio. Not there yet. In fact, it's too bad that the Fed meeting is on Wednesday, and I normally make decisions Tuesdays, as I say in the letter today. I kind of reserve the right to make these decisions later in the week because the market has been acting like it's just waiting for whatever the Fed is going to do and what Powell's going to say, and maybe what the president's reaction is, and maybe what the bond market's reaction is, and the stock market's reaction. It's all a chain of events. Again, it's all like one trade. Okay. And so does it really matter what that consumer staples stock or whatever is going to do? Yeah, over periods of time, short-term periods, yeah. But ultimately, it all gets taken away by the tide that is the indexation and the algorithmic trading and what they do to our money. So to finish the defense, I won't maybe always use RWM here, but I do not love small caps. They're doing quite well recently. Again, self-fulfilling prophecy. Oh, small caps supposed to go up at the end of the year. So small caps go up. Does that have anything to do with fundamentals? No. Has to do with somebody has an algorithm that says when the calendar hits this, buy small cap. And they control so much more money than all of us that we have to be conscious of what they're doing at all times. And that is what the charts do for me. And that's why being a chartist has never been better than it is now. And then here, this is going to be like a wild card defensive position. UVIX basically is like double the VIX. So think of it now. The VIX is 15 to 20, give or take, has been for a while. But when it spikes, like it did last April, like it did in 2020, okay, the surprise attack, the sneak attack, I am willing to have a portion of this neutral allocation is 3, which is what I have right now. I go up to 5. Of course, this thing moves like wildly, okay? I'm going to look for other things like it. Maybe it could be a triple levered inverse ETF. I don't know. I wish there were an ETF that would simply just buy put options and be done with it. But that, to my knowledge, does not exist. There's one that sell put options. They buy call options. They sell call options. They don't just buy put options and hold treasuries. That would be my hedge. So I'll see what I can concoct here in the research. But, twice the VIX, that means that this thing in a market crash, like if it happens within a couple of weeks' time, this thing has a history of going up 500-600%. I think it might have even gone up 800% one time. So again, it's not a big position to take unless you're a gambler. Okay. But if you even have 3% in something and it doubles when the rest of the market's going down, you just added 3% to your total portfolio, which will make up for all the sucking wind that's going on in the offense. That's risk management. That's risk management. Okay. So, and I'm free to answer any of your questions about what some of this other stuff means. Again, I haven't filled it in for this week, but as we ended last week, had these two focused here, playing off the Qs and the DIA, slightly favoring the Qs. A little bit of oil exposure, a lot in the T-bill, which is kind of what's led up to this week, which is there's nothing going on. I might as well collect, 4% while it's still paying it, 4% annualized. A little bit in the bonds, but, the Fed move tomorrow could prompt me to make this a much bigger player than what it is right now, which is off the sidelines. Okay. If long rates are going to spike, then I start seeing how close I get to maximum 30% here. I put constraints on all this. That is also part of risk management. Okay. And we'll see about these others. Okay, so I'll finish with the charts, but first I see some questions. Let's see. Okay, good. The screen is shared. Skipped a beat in the old ticker there, thinking I had been scrolling around here and nobody was seeing it. Let's see. Well, okay, what percentage of the account that you will swing trade? That is an excellent question. I think you're talking about what I alluded to before, which is the account at PiTrade is the name of the firm, PITRADE, PiTrade.com. You'll see it a lot pretty soon, but I mentioned it here. So what percent will I swing trade? I haven't decided yet. But my guess is it will be in the 20% range. Frankly, a lot of it may depend on the Roar score. The idea is to take the Roar score, allocate it between the normal SPY and bill, and then make an additional decision I don't make. The normal decision with SPY bill to ETF portfolio, as well as it's done, it can always be better. And I've tried to figure out ways, can I make it more aggressive and this and that? Can it doesn't short. Right? SPY doesn't go short. Bill is not short. So if the market sets up for another 60% whacking over the next few years, as I've seen twice in my career, well, to just be sitting in cash that whole time would kind of stink. So I want to be able to get some of this other stuff into there, even if it's for days or weeks at a time. And as people know, I've really tried to disseminate as much of my sort of up to a moment's notice, trade alerts and things like that. But the fact is the markets are just not set up to disseminate anything other than intermediate to long-term thinking. So that's kind of what I like about the copy trading, that I can just do it there and people can sign up. And honestly, they're just, they're not asking people to put tons of money in there. They're asking them to almost be like part of the beta test. I think the initial account I put in was like $1,000 because they use fractional shares. So it's more almost like a cheap research service to see the moves and then decide what you want to do. I mean, I would tell you that, straightforward. I think it'll be much bigger over time, but that's how it's starting. And that's why we agreed to jump aboard with them. By the way, those of you who are familiar with Jack Bowman, Jack is one of the other strategists on there. Neither of us are managing the money directly, but we're providing the models that can be traded. So anyway, okay. So so maybe it's 20%. I mean, look, personally, my own accounts, how much do I swing trade? I'm just trying to add it up. I mean, my trading work is probably about 20%, give or take. Sometimes it's zero. Sometimes I'm doing nothing. Sometimes I'm using options as a surrogate. I do a lot of that. I literally took like a really small amount of money, a fraction of a percent, and said to Dana, you know what, put this in an account, and all I'm going to do is I'm going to learn if there's any efficacy in trading zero DTE options. Okay. Like $100 here, $100 there, a couple of $100 there. And what I'm finding so far, it's my experiment because I'll experiment with my money and then I'll tell you about it. You can decide if you ever want to do anything like it. But these things are interesting because, yeah, you can chart them and all that. But, anytime the market opens wildly and suddenly, like day of or day after, a week after the Fed has done something or a long weekend, okay, the market moves like a 0.5% in either direction. Now you can turn $100 into 200-300 when the market opens and then go on with your day. I'm not recommending anybody do that. And I'm just telling you that I'm looking at it as a naturally curious investor and trader to try to see if there's a way to capture that. How might I use it? Well, if we get to the point where the markets are just so zany, then one place my mind goes is to say, if T-bill rates are still reasonable for every proverbial $100 I take, I can say, you know what, for a year, I'm going to sit in T-bills at 3% or 4%, whatever it is. I'm going to take $100. I'm going to take 96 or 97 out of the 100, and I'm going to put it in that return. So I know I'm getting my 100 back at the end. And I'm going to zero DTE or otherwise swing trade the rest of it, knowing that my worst case return at the end of a year is the accretion of the T-bills from, let's call it 97 to 100. I could lose the other 3% with whatever type of semi-speculative trading I'm doing. I'm still going to break even. That's also risk management. So again, it's not as simple as what stocks should I pick to be a risk manager? Like, it's not really the right question. And this is all about what we tell you, which is, we'll try to give you some picks along the way, and I'll rotate through this structurally. But we're trying to teach you to fish, not just give you a fish. All right, let's see. Why the decrease in RWM? What about the chart? Okay, well, let's use that as the impetus to get to the charts. So, first things first, and I started with this one. I kind of set this up ahead of time for a reason. If I look at the S&P 500, I've got some old markings here, by the way. All right. So, yeah, it hit right where it's supposed to. But note here, this is a 1 hour chart going back 2 months. That's it. Okay. I look at multiple time frames, and what this is telling me is it's rolled over. It's borderline rolling over here, but this is very, very fleeting. 1 hour time frames only going back a couple of months. But I can't get to a longer term view of the market until I see what's happening in the short run. It's like a domino effect. No major move in either direction can start until the shorter term charts start to go. There's almost nothing to be gleaned from this other than it wouldn't surprise me if the market fell, but it's only a 1 hour chart. So now let me go out to all the way out to a daily. And you see that same line there, okay? This is why if somebody says, hey, Rob, what should I do now? Any new ideas? No ideas. Manage risk, wait for this sort of, I wouldn't call it manipulated, but machine-driven modern market. Not going to change, so we have to figure out how to evolve with it. How's that going to happen? I mean, this is great. You can even see it, this 20-day moving average. I'm actually working on a little study that could make this the definitive risk indicator. It's a part of the Rohr score, but it's not all the Rohr score. But you see, when the 20-day moving average is moving up and not just completely rolling over, it's a rising S&P 500. What's it doing now? It's doing a whole lot of nothing. It's where it was before. Okay. And what I'm looking for next, and the PPO helps me a bit, but really it has to do with this red line here. If this red line finally rolls over, not fake out rollover here, okay? If it rolls over, that's going to tell me that there's more than just very short-term momentum to the downside. Then the next thing that will happen is, like on that last chart, this thing will cross below zero and it will go. And the best way to see what that might look like is basically, let's see. It's like here, you are here, okay? All right. I don't know if you can see, but this, and this looks quite a bit like this. And it's been going on for a long time here. Okay. I know bull market and the whole thing, but I mean, really, we haven't gone anywhere for a little while. And so that's why there's no signal here. Okay. And if I look at a weekly chart, I'm telling you, because I did, no different. But what happens if we look at this? And I'll get to the small cap in a minute, but I'm working my way there through RSP. So RSP is a little bit more like a small cap, even though the stocks are larger, because it's basically not leaning toward having all of its money stuffed into the biggest companies. So in that sense, anything non-mega cap is you're going to get a hint here, okay? And the fact that this market is so connected is shown in the fact that RSP and IWM, the small caps, have moved very similarly for a while now. I'm going to shorten this because it's easier to see if we're going to go back 1 year. Okay. Now, again, not much here, but I'm going to go back a little further. I want you to see something. I believe I wrote about this, but here, I'm going to show it to you right on the chart. Okay. Starting to think I should be doing more of this type of stuff every week. So here, 11/29 of 24. So you're talking just over a year ago. Where was RSP? Where to close? 184 and a half. Was that the high? Yeah. So call it 184. Where is it today? 190. It's up $6 a share on 184. So that's 3.5%. The average S&P stock in just over a year is up 3.5%. What I'm really doing here is I'm going into much more depth into what I've been writing about and will continue to write about until people get it. Okay. How does this one look since November of last year? Yeah, let's see. Is it up 3.5%? It's gone from 595 to 683. So that's 88% on 595, 15%, just about 15%. 15% when you weight them like this, and when you weight them equally like this, 4%. If you go back 3 years, because I just did this, I think for an article I'm about to put out, you go back 3 years, we're now looking at the highest historical underperformance of RSP, average S&P stock, from SPY, cap-weighted S&P, same stocks, different weighting. This is the highest 3-year gap between SPY and RSP in recorded history, which goes back about 20 years. I don't think that's a coincidence. That is telling you that the market works differently. The question is, okay, Rob, well, maybe this will turn around at some point. Maybe it will, but I'm not holding my breath because I just think there are systemic factors that are screwing this up. So now let's go down one more step to IWM. Now, I have bigger issues with IWM, no matter how much it goes up, because these companies, frankly, if interest rates go up, and this is the relationship that if there's like a, hey, Rob said something that made me smarter, hopefully I do from time to time, this might be that moment in this week's session. What's going to make you smarter? Well, why would what would really, really hurt small caps? Thinking about the fact that 40% of the Russell 2000, about 800 companies, are surviving on their ability to refinance their debt. And there is a huge debt cliff for small cap companies, which started this year, but really I think kicks in next year and the year after and the year after. Translation: if you are a smaller company and the only way you can stay in business, keep the doors open, is by refinancing, rolling over debt. What's going to happen if you are borrowing in a rate determined by the 10-year Treasury, and the 10-year Treasury rate, all of a sudden, let's give it some more context. The 10-year Treasury rate, which is sitting here, go back even further. There we go. Okay. You see this? This is ready to do something. It's a Fed meeting tomorrow. I don't know if that'll do it, but this has been heading to something. I've been talking about it for a long time now, in the writing and in some of these sessions. Okay, it's leaning like rates are going to go lower, and it's going to be a panic, and we're going to have a recession. I'm quickly fast forwarding to what might rationalize that in the real world. Okay, not that I care because I'm a technician. So, but look at this. Okay. I mean, if you go back long enough, all right, and you think, wow, how bad could this get if people really are concerned about either U.S. inflation or U.S. lack of willingness to address the debt and repatriation and trade wars and tariff wars and all this stuff, okay? I'm not saying it's going to happen. I'm saying it's a threat. It's a threat, okay? It could go here or it could go here. And if it goes here, well, next logical stop is 5%. From 419 on the 10-year to 5%, that alone would freak people out. If it goes over 5%, now you're really freaking people out, because look where the next stop is. Back to, oh, look at that. Right before the dot-com bubble peaked, okay? Right before the dot-com bubble, you had rates come down, they spiked up, and then flight to quality. And then they were never here again. So again, I'm not telling you what's going to happen. I'm gauging the range of possible outcomes, or what I call ROPO. I don't know if we're going to get to 7, but we got to get to 5 first. But this move, whether the 10-year goes to, let's call it 3.5 or 5% first, is going to shake up everything, in my opinion. And that's why the Fed meeting matters to me tomorrow, because the long-term picture, and it's another brick in the wall, so to speak. It's not because, oh, what's the Fed going to do and how many times and what's the dot plot and whatever. Do not care about that. Everybody else, let them care about it. Okay. That's what I'm looking at here. Now, going back to small caps, what does that mean for small caps? What if those rates go up 5, 6, 7%, and you're a company that's got triple B, double B, single B debt, like a lot of small caps do? What do you think's happening to your cost to borrow to keep your business going? Up. It's like a residential homeowner who has a balloon mortgage that goes from, I don't know, 5% to 9%. As soon as it balloons, they have two choices, most likely, unless their financial condition has really changed. They can sell the house or go into default. And that's what worries me about small caps. So much so that my token inverse for now, and look, maybe this will resolve itself. Lower interest rates would help. But right now, okay, this is the chart of RWM. I mean, it's hard. You kind of have to look at the main one. You have to look at IWM. It's hard to chart an inverse because the math is different. Okay. It's certainly pretty low. It was hinting at a breakout. You see this, but it wasn't reliable. And that's why I had a position in there. I might get rid of the whole thing. We'll see. We'll see. Okay. I don't want anybody to think too myopically about any of this stuff. I promised a Bitcoin chart, and before anything else you have, okay? So Not so much because it's Bitcoin. I think in the especially with the Roar score stuff coming out, and I've got uh, this little cheat sheet here, which will probably modify a bit. Okay, the folks who are working with me are doing a great job on that. Okay, this sort of color coded thing here. So what I may do here, if you folks would like it in these future discussions, really focus a lot of time on kind of like I used to do with Jack Bowman. Show me the chart, okay? Like, all right, let's take something and show me something that's stretched, show me something that's undecided, show me something that's fading and rolling, etc. I mean, I don't know if everybody wants to be a chartist or you just want to let me do the work. I'm happy to do it. And it's really part of the service, because I'm not a fundamental analyst. So when I look at something like this, I say, okay, it's not there yet. That's a sort of a shaky, non-committal. Okay, Bitcoin's 20-day moving average looked good right about here. You see where I am? And the PPO, same thing. See, PPO crossing zero, and this thing getting to here. Maybe you missed a little spike, but you had a nice run up in IBIT Bitcoin ETF. It's hinting at this right now, but you see, it's like it's almost giving you a message like, I want to get there, but I can't. I can't get there in one shot. Okay. And this is probably going to be held hostage by risk management, I should say, risk on behavior in general. If the Nasdaq's flying, this is probably flying. Okay. If people are peeling back from their stock portfolios, I think this is just another risk asset. That's what Bitcoin is. So this is like the chart pattern that says, so you're saying there's a chance. There's a chance. Am I going to pile into it? No. Would I buy a call option? I mean, calls are very cheap on it. I mean, very expensive on this. So much volatility. Maybe I can tell you this. I bought a small position in, I can't even remember the ticker symbol. I think it's BitX, maybe 2 times leveraged IBIT. Tiny little position. Get it on my screen. Make a few bucks on it if I'm right. Not lose a whole lot if I'm wrong. This is what I do all the time. I don't like to think of it as tinkering. I think of it as putting mnemonic devices in my portfolio so I know what to come back to. Got that from Peter Lynch, the old Fidelity manager. So anyhow, all right, let's see. Okay, Teresa says, I like learning the charts from you. Amen. Amen. A women, a children, and everybody else. I love to do this stuff, and maybe to focus these discussions a little bit more, especially outside of this quarterly where everybody's invited and where it's specifically the investing club members. Yeah, would love to do that. Okay, yeah, PPO goes below zero is not good. That's it. That's it. Yep, that's right. Okay. I've thought the same thing. We're looking at March. Let me go back to the SPY to finish up here. Okay. And yeah, let's shrink that up again. Yeah. I mean, the problem with the market these days is that you get a lot of what I call fake out breakouts. Like this could have been, oh, look, it's going positive. Okay. This is what I'm working on in my research and fine tuning the rule score stuff before we bring it public. There's too much of this stuff. There's too many things where it goes flying higher very sustainably. And most technical systems will say, hey, this thing is, this thing's a great buy. It keeps them as a buy. When I look at it and say, if it's up that much, it's automatically not as attractive as it used to be. So we'll cover a lot more of this. All right. I promised that I would go into the Dow here, and I'm going to do this in about 2 minutes flat. I'm going to put this here. Let's do it alphabetically. And just as a quick little drill here using daily charts, unless there are any questions from you, I will bring you through, because at least we can say, hey, you know what? Rob tried to find us some great looking stocks to buy in the Dow, and he couldn't find any, because I don't know if we're going to find any. Let me see. Better to do that as a year. Now I'll keep it as the 2 years. Okay. This week I'm doing dailies. I could easily do weeklies, monthlies. Apple, strong chart is what I call stretched. You would get a 40 roar score because it's less likely to keep doing what it's doing, but it's right around a 50-50 shot because of where it's gone. And I wouldn't be putting new money into it. Amgen rolling over with the rest of healthcare. That's not good. I won't put a RUR rating on every one, but visually, I would say, it's probably in the 25 range. Okay. 25% chance that it's going to make a big move up before down, 3-1 to the downside. All right. Amazon is showing signs here of rolling over. American Express, kind of neutral. That'd be like a 50. Boeing also kind of directionless. I mean, it's moved up, but when it happens this quickly, you have to be skeptical. That's what this market does. In fact, let me go back to that. Okay. This is the problem right now with the stock market. You see like, these kind of shenanigans. Okay. 213 to 226. That's not bad. 5-6% move. And then right back down. Then right back up and then right back down. Okay. That's why having a picks list for stocks, it just doesn't work the way it used to. And I don't want to waste people's time by giving them what they think is going to help. I think a lot of the other folks are still doing that. All right. Caterpillar, again, kind of like Apple. It's stretched, but nothing to do. This is also not actionable because it moved up too quickly. If it breaks through here, maybe it's another story. Salesforce. Next. Cisco. Cisco is intriguing, except for the fact that, I mean, the stock's doubled in a couple of years. And look, I mean, the PPO is so high here. That's why I use them together. Okay. This looks nice. Nice little trend. This is a 50-day moving up to. This is a little too high. This would have been a better place down here. Okay. It's all just momentum and putting sort of a ceiling and a floor on what's possible. It's like putting a bracket around the chart, kind of like a collar. All right, Chevron. It's a nothing burger. I mean, it's kind of trending down, but no sudden moves yet. Again, Disney. It almost looks like the Bitcoinish chart. It's trying, but that's one where you can take a shot on it, but it would be kind of an early high risk buy, if anything. Okay. This is the best one I've seen so far, but it's not gorgeous. It's already kind of made a big part of the move. By the way, if Goldman's the best looking chart and JP Morgan is the second best looking chart, I'll give you a few minutes till I finish with the 30 Dow stocks here. Goldman Sachs, if Goldman and JP both look good, somebody chat me as to what that probably means with what's going on this week. Okay, Home Depot rolling back over. So that one does not look very good. And by the way, this is one of the reasons I love the Dow. Let's see. If Home Depot's not doing well, but Goldman Sachs is, what does that mean maybe? All right. Honeywell, kind of flat. Nothing to say there. This is also nothing interesting to say on IBM. J&J rolling over with healthcare, but not quite as severe as Amgen was. Okay, see, that's a nothing burger. All right. Goldman looked good. And again, when earnings come out, it really screws these up. And I look at weekly charts instead. I am not sure what the news was on JP today, but it was down a lot. Okay. Coke does not look great. That's a classic staple. McDonald's very flat, nothing there. 3M declining. Again, kind of consumer adjacent, right? Scotch tape and Post-it notes. Okay, Merck. Healthcare looks pretty bad across the board. This little engine that could, this tiny little Microsoft stock, right? That's why they call it Microsoft, because it's a small stock. No, just kidding. Trying, not nearly there. And when it's trying to crawl out of a downtrend, it's a high risk speculative buy. But other than that, I wouldn't use the word buy with it. Okay. Nike looks kind of sanguine there. Nvidia, I mean, technically is crossing over, but who knows? And let's face it, where's the S&P going if Nvidia is not going up? Okay, not to mention the Nasdaq. Procter and Gamble. I think I mentioned this in the weekly last couple of weeks. Procter and Gamble didn't look good. Matter of fact, yeah, I think I made a joke about again, it looks more like a Gamble than a Procter or something like that. And yeah, sure enough, it follows through. It's not magic. It's just it's just the way the markets function and using the charts to picture it. Okay. Sherwin-Williams, again, it's done this before. Not what I call high conviction. It's still working its way through. Okay. I try to put almost a personality to these. This one does not know what it's doing. This one probably getting a well-deserved rest from tanking for most of the year. Been about a year since the tragedy where the fellow was killed by Mangione. Oh, I'm sorry, allegedly. Anyway, this is a downtrend. So whatever it does, it's climbing a mountain. It's trying to dig out of the quicksand here. Two more left. Verizon, just kind of messing around, not much. And then here's Walmart, which was looking good for a while, but again, maybe too little too late. So let's sum it up. Goldman looks the best of them, but I wouldn't call it gorgeous. Healthcare looks pretty bad. And anything kind of consumer related looks at best weak and maybe getting weaker. What do you think? Let's see. One guess was higher rates. The other was finance going up. You know what? Usually, if it were across all the banks and financials, I would say they like a steep yield curve. They like short-term rates to be very low so they can borrow at those rates, and then they can lend at much higher rates. So a steepening yield curve would seem to favor Goldman Sachs. We know there's a good chance the Fed will cut and cut again and maybe cut again. So the short end of the curve, that's all they control, not the 10-year. They control overnight rates from banks, among banks, and from banks to the Fed. Okay. Discount rate and the discount window and all that they talk about. So short rates going down, that seems like a fait accompli. But what about the long end? That's why, to me, it's so intriguing that the bond market, the 10 to 30-year treasury, is going to tell us a lot, because the higher those rates are, it could be good for the stock market, because I should say good for financial companies, but for the broader market, I think if borrowing rates are going up and the consumer's getting squeezed because a lot of stuff they do is off of 10-year rates, that could be a problem. So let's see. There's no right answer. The charts will give us a sense, but you see how I take the Dow 30 and I just try to come up with some sort of, dare I say, narrative to be able to do this. And boy, my voice and my brain are both tired. But I'm happy to take any other questions before we leave. Seeing no questions, we will close up for today. See you in the chat. And you're welcome. And see you next week.